Today I'm joined by James Uphaugh, who is the fund manager of the Edinburgh Investment Trust. There have been some signs in recent months that investors have been returning to the UK market based on fund flow statistics from the Investment Association. But overall, it remains fairly unloved. There's been a number of overseas companies that have been making bids for UK firms of late, but investors don't seem to be viewing the UK stock market as a bargain. Would you agree with that?
Yes, but that's the opportunity, Carl, because what you're seeing at the moment is, as you rightly say, you're seeing particularly private equity really sort of fall over themselves to get involved in some of these companies. The latest is the bidding war for Morrison's. And, if you take a step back, why is that happening? That's happening because the UK equity market is a very open market. It's rammed full of very high quality businesses with decent ESG credentials, decent governance, and often they're market leaders in their space, often with a global market leadership as well. And, private equity has oodles of dry powder that it's really mustard keen to get to work. So I think you're going to see more bids from private equity, more bids from corporates. But also what you're seeing is a firming up in expectations elsewhere. So a number of the areas which, have been under the cosh, you're seeing a firming of expectations, you're seeing buybacks pick up, all of which I think, are good indicators because you've got corporates buying, you've got the companies buying. In time you will get private investors buying, but actually the first two are arguably better indicators of value. And if you buy into that sort of thesis, if you like, of the opportunity, I'd say to you the Edinburgh Investment Trust, managed at a firm, Majetti, which has a long heritage in outperformance in UK equities, is actually quite a good vehicle to capitalize on that. And the interesting thing is, at the moment, the trust is also at a high single digit discount to NAV. So decent discount to NAV, and an interesting way to play what I think is going to be the UK renaissance of the future.
I wanted to move on to portfolio activity over the past couple of months. What have been your most recent buys and sells?
Yeah, I mean, in terms of most recent additions, we've added pretty substantially to the likes of Essential, which is a data e-commerce analytics company. It's really pretty much the market leader, growing very, very strongly. I think a pretty exciting company. We've added to Domino's, we've added to NatWest, we've added to Tesco, just to name a few. In terms of how we funded that, well, we've sold. Standout really is we've sold our holding in Associated British Foods, pretty high quality conglomerate, but one of the big drivers of the valuation is what's happening at Primark. And I think Primark, with its relatively long lease and freehold structures, often orientated towards high streets, and its lack of online, it makes certain question marks over the sort of medium-term assumptions, I think, in terms of what sort of like-for-likes and sales densities you're going to get out of that business. So we've decided over the last 3-4 months to exit that. So those are the major transactions which we've undertaken.
There are a number of themes in the trust. One is Darwinism. Could you explain what that is in terms of a theme and a couple of companies that fit into it?
Yeah, I think this is a really interesting theme, which I think has been accelerated by COVID and indeed the supply chain shortages, which we've seen, the stress in supply chains. And it's really this idea that actually the growth that's available in any market accrues in an outsized way to the number one and number two in an industry. And this is happening in so many industries. If you look at, for example, Dunelm, for example, Dunelm is a business that has about 9% in homewares and has about 1.5% in furniture, but it has ambitions to broadly sort of double that in homewares. And if you think about its competition is pretty fragmented, or a number of the sort of department stores that have been, if you like, retrenching in that area. And so actually the available demand is actually accruing in a outsized way to the likes of Dunelm. And this has been accelerated by what's happening to supply chains at the moment, because as you know, with the very, very strong demand, particularly that we've seen from the States, it's led to a real issue in terms of getting goods from A to B. We've had issues in Suez, we've had where the containers are, we've had issues with Chinese ports. And so Dunelm, which has a very conservative supply chain, where they've worked with suppliers for a long time, is actually pretty well placed to navigate that. Indeed, throughout the crisis, apart from lockdown 1, they continued to order stock, so their stock levels are up 30% year on year, and that allows them to actually satisfy demand. So that's a good example, but I could have talked about electrical components, I could have talked about Greggs, I could have talked about Whitbread, Serco. It's a very, very powerful theme that I think really has legs. But Darwinism is one of many themes, but I would say to you it's the biggest theme in the portfolio at the moment.
Supply chain issues elsewhere in other industries has been one of the main factors behind inflation levels being on the rise. Is inflation the one non-COVID risk for markets at the moment?
Yeah, I mean, I think what we've seen, if we take a sort of a step back, over a few decades, we've seen as China and other big countries have moved into supply chain. We've seen more and more elongated supply chains, and this has obviously been put under huge pressure by the sort of whiplash effect of demand stopping and then coming back with a vengeance. And it has led to definite geysers of inflation. And I think we are going to see goods price inflation, move up a notch. Because if you look at inflation over the last sort of 15, 20 years, what you've had is sort of service inflation sort of moving up, sort of low single digit, but actually goods price inflation being very quiescent. Now what you've got is goods price inflation moving up, and I think it probably will keep on moving up. And I think it is a little bit of a risk, but I think the major risk is probably more in the more highly rated growth stocks, which are more dependent on a low discount rate for their valuation. Indeed, I'd say to you, in terms of the trust portfolio, a number of the holdings, be it the banks, which like a little bit of inflation, or, for example, Hayes. Hayes actually, it has been working with very little wage inflation coming through its P&L, because it loves wage inflation, because that's what it's effectively distributing. It's been working with very, very little wage inflation over the last decade. So if it were to get some wage inflation, which would naturally come from what we're talking about, that would be very good for the P&L. So I think, for us, we are primarily stock pickers, but I'd say to you that, the inflation feature, I think we've thought about it, we've incorporated it, and we should be reasonably okay on that front.
And finally, a question that we now ask all fund managers that appear in our video series. Do you personally invest in the Edinburgh Investment Trust?
Absolutely. You know, for all the funds which I'm involved in and I'm talking to customers on, I wouldn't feel comfortable talking about the funds if I didn't own a chunk of them. So, I've been managing it for 17 months and I own 43,800 ordinary shares, which in rough terms is about £260,000. And, I think it's an important question, frankly, and I think managers should own decent amounts of the trusts or the funds they manage.
James, thank you very much for your time today.
Thank you, Carl.